Welcome to the Deep Dive, your shortcut to being well-informed. Today, we are digging into a really explosive earnings call from Dollar General.
It really was. They dropped their numbers for the third quarter pre-market. That's the quarter ending October 31st. And market reaction was immediate.
Absolutely. So our mission here is to take you inside that call, break down the numbers, the strategy, and figure out what this means for them heading into the holidays and, beyond.
This was a big one.
Okay, let's just get right into it, because the headline number, specifically the earnings beat, was so big, it basically pulled the stock out of Wall Street's penalty box overnight.
An understatement. I mean, we're talking about a GAAP diluted EPS of $1.28.
And the consensus was what, somewhere in the 90s?
Yeah, the street was looking for 94, maybe 95 cents. So this wasn't just a beat. This completely blew expectations out of the water.
We're talking a 35 to 40% surprise, a 43.8% jump year over year. I mean, when you see earnings grow that fast on pretty moderate revenue growth, you know the story is about internal fixes.
That's it, exactly. Revenue was basically in line, $10.6 billion, up about 4.6%. But the really telling number for me was same-store sales.
Right, the comps, they came in at a solid 2.5%.
A very solid print.
Yeah.
And management was crystal clear on what drove it. It was 100% driven by higher customer traffic.
Which paints a fascinating picture of the consumer, doesn't it?
It really does. People are coming into stores more often,
Right.
and this is the key,
Yeah.
they're buying less each time. The basket size is pressured.
So they're managing their cash day by day, trip by trip, desperate for value, but only buying the absolute necessities.
Precisely. And management's basically holding this up as proof that their turnaround plan is not just working, it's gaining real traction.
Okay, so if revenue is up 4.5%, but earnings are up almost 44%, we have to talk about the profit engine. This is a margin story.
It is the story. Operating profit jumped over 31%. The main driver was gross margin, which expanded by 107 basis points to hit 29.9%.
And for anyone listening, 107 basis points is over a full percentage point of margin. In retail, that is a massive improvement.
It's huge. And it wasn't about price hikes. This was almost all operational execution.
And the main lever they pulled was shrink.
Overwhelmingly. Lower shrink and, to a lesser extent, better inventory markups. But the shrink improvement was just staggering.
Let's just define that for a second. Shrink is basically inventory loss from theft, damage, admin errors, that sort of thing.
That's right. And management said that fixing shrink alone contributed 90 basis points of operating margin expansion. 90.
Wow. That's almost the entire margin beat right there. It feels like they're fixing this problem way faster than anyone maybe even they thought was possible.
They're throwing everything at it. Better cameras, better staffing, centralized receiving. It's a systemic fix, not just a Band-Aid. And the market is finally giving them credit for it.
And that operational focus flows right to the balance sheet, right? Looking at the inventory number.
Yeah, a huge improvement there. Merchandise inventory was down $465 million year over year. That's 6.5% overall and over 8% on a per-store basis.
To cut inventory that much while also growing sales and keeping shelves stocked, that's the holy grail of retail efficiency.
It is. They're running leaner and smarter.
Yeah.
And they said they're just getting started, especially on reducing damages, so there's more margin to be found there.
Okay, what about the cost side? SG&A expenses.
SG&A, which is, the cost of running the business, was up just a little bit, about 25 basis points as a percent of sales.
And what was that from?
Mostly higher incentive compensation.
Which is actually a good thing in this context. It means you're paying people bonuses for hitting these incredible turnaround targets.
Exactly. It's money well spent when you get that kind of EPS growth. The cost control is there, which is what's letting all these operational fixes flow straight to the bottom line.
So the back of house is firing on all cylinders. But who's driving the traffic? Who is the Dollar General shopper today?
Well, the core low and middle income customer is still, in their words, severely stretched. That's what's driving the frequent small basket trips we talked about.
But there's another piece to this puzzle. They mentioned a new shopper showing up.
They did. They're capturing a growing share of higher income households. The trade down effect is real. People with more money are actively seeking out value.
And Dollar General is meeting them with a very clear value proposition.
It's resonating. They're keeping their prices 3 to 4 points below the big mass retailers. And they're leaning hard into that extreme value with over 2,000 items at or below $1.
That $1 price point seems to be the magnet.
It absolutely is. Their Value Valley section, which is about 500 rotating $1 items, was the single best performing part of the store. Comps for those items were up 7.6%.
7.6. That's just a stunning number. It tells you everything you need to know about the consumer's mindset right now.
It really does. And all this success gave them the confidence to do something pretty bold with their full-year guidance.
A huge guidance leap. They raised their full-year EPS forecast to a new range of 630 to 650.
Which is way up from the old range of 580 to 630. It signals that they believe this Q3 performance isn't a fluke. They see this momentum carrying through the holidays.
That is a very confident signal. Okay, but let's introduce some friction here. I mean, relying on traffic while basket size shrinks feels fragile, doesn't it? What happens if those higher income shoppers trade back up when inflation cools off?
That is the risk. The whole model's sustainability depends on making that trade-down customer sticky and on leveraging their other big strategic advantages.
Let's talk about those. Let's move from the short-term fix to the long-term growth. Real estate has always been their thing.
And it still is. They see themselves as deeply underpenetrated, especially in rural America where, 80% of their stores are.
And the number they put on their future growth potential was kind of mind-boggling.
11,000. They see a potential pipeline for 11,000 more locations in the U.S. A lot of that is from drugstores and other retailers leaving these smaller towns.
So they have a runway for growth that almost no other major retailer has. What are the plans for next year?
For fiscal 26, they're looking at 450 new stores. And those new builds are still delivering great returns, like 16-17%, with a 2-year payback.
And they're also upgrading the existing stores pretty aggressively.
Very aggressively. 2,000 of the big Project Renovate remodels, which give them a 6% sales lift, and then another 2,250 of the smaller Project Elevate remodels for a 3% lift.
So they're building new stores and making the old ones work harder. It's a two-pronged attack.
Exactly. But the physical footprint is now being matched by a pretty impressive digital moat.
Which is something people used to laugh about with the dollar stores.
Not anymore. Look at the DG Media Network. It's leveraging all their unique customer data from rural America, and it's seeing double-digit growth. Management calls it the second inning.
The convenience factor has to be the key, right? Especially with delivery in those rural areas.
That's their unfair advantage.
Yeah.
They have delivery through their app, DoorDash, Uber Eats, serving 17 or 18,000 stores. And get this, over 75% of orders are delivered in an hour or less.
Try getting that from Amazon in a town of 5,000 people. It's just not going to happen.
It's not. And these are new sales, too. The digital orders are over 70% incremental, and the basket size is way bigger. So it's bringing in new customers and new types of shopping trips.
Okay, let's bring it all home with the balance sheet and the market reaction.
Very disciplined. Cash flow from operations is up 28% so far this year to $2.8 billion. And they're putting that cash to work.
By paying down debt.
A lot of it. They redeemed $600 million in notes early in Q3, and they're doing another $550 million in Q4.
So over $1 billion in early debt repayment. That sends a very strong signal about their confidence in future cash flow.
It does. They want to get their leverage back under their target, and they're moving fast to do it. It shows a real focus on financial health.
And the market's reaction was just thunderous.
The stock closed up 14% on the day. Volume was 3 or 4 times normal. It was a massive vote of confidence. The narrative has shifted from show me to I believe you.
A huge turnaround story. The stock is up over 39% in the last year, really leading the sector.
The tone is now what I call constructively bullish. The market believes the fixes are real and sustainable.
That's a great summary. Okay, now it's time for our segment where we pitch an outrageous but plausible trade idea based on everything we just heard.
Welcome to This Is Not Financial Advice.
All right, so we have to acknowledge the stock has already made a big move, and the story does depend on that fragile consumer and continued operational wins. But there's an interesting relative value play here.
Okay, I'm listening. What's the play?
The idea is to go long dollar general, ticker DG, based on this accelerating recovery, the 11,000 store pipeline, and the scaling DG media network.
And you pair that with a short position.
Exactly. Simultaneously, you take a short position on a more urban-focused convenience retailer, one that's maybe not capturing that trade-down consumer as effectively.
So the thesis is that DG's unique rural moat and margin recovery will drive a bigger expansion in its earnings multiple through 2026.
That's the idea. We think it's set up to outperform not just its direct peers, but also the broader consumer staples ETFs. It's a bet on who can win the last mile in rural America, and right now, DG is proving they can do it profitably.
Interesting setup.
So, to recap our deep dive, a massive EPS beat, driven by higher traffic and incredible operational execution, especially on shrink. That fueled a big guidance raise, all while they lean into their huge real estate and digital advantages.
That's the story in a nutshell.
Which brings us to our final provocative thought for you to chew on. Management hinted that AI could bring even more efficiencies to their supply chain and stores, efficiencies that aren't even in their long-term models yet.
Right, they see it as pure upside.
So the turnaround is already ahead of schedule. What happens to their long-term margin targets if the second inning DG Media Network and these new AI efficiencies start to converge even faster than anyone expects?
That's a powerful thought. It suggests that even after this huge run, the upside might still be underestimated.
Thank you for joining us for this deep dive into Dollar General's Q3 2025 earnings call. Remember, everything discussed here is for informational purposes only and is not investment advice.